Hi, and welcome to Chapter 14, Payout Policy. So in this chapter, I'm going to be talking about cash payouts, their tax treatments, the role of dividend reinvestment plans. We're going to talk about the residual theory of dividends and key arguments regarding dividend irrelevance and relevance, and discuss key factors involved in establishing a dividend policy, as well as review and evaluate the three basic types of dividend policies, evaluate stock dividends from an accounting, shareholder, and company point of view, and explain stock splits and the firm's motivation for undertaking them. Okay, so let's start out with the basics of payout policies and the elements of payout policy. So when we talk about payout policy, really talking about the decisions a company must make regarding whether to distribute cash to shareholders, how much cash to distribute, and by what means the cash should be distributed. So, cash can be distributed as dividends or through stock repurchase plans. So, let's just reverse here a moment. Remember, when a company makes money, there's two things they can do with their net profits. They can keep them, and it becomes what we call retained earnings, or they could return them to investors through a stock dividend or a repurchase of stock. So this is basically what we're going to talk about in this chapter is the why companies worry about this and what's the best thing for them to do. So first, let's think about the basics of payout policy. So here's some general lessons. One, rapidly growing firms usually do not pay out cash to shareholders. Why? Because they need that cash to keep reinvesting in the growth. So if they're going to maintain their fast-growing company, they don't have any money to waste on dividends. They're probably using all the retained earnings to reinvest in the company and then borrowing even more money to keep the company growing. Now, the opposite of that, a slow growth company with good cash flow that generates and favorable tax conditions will prompt a lot of these types of companies to pay cash dividends to investors, like a utility. So, a utility has a very reliable source of income that generates a lot of cash flow, and they can afford to pay a more consistent dividend to investors. Um, Now, these cash payouts can be made either through dividends, where they directly give cash to the shareholders, or stock repurchase, where they take the cash and buy stock, with therefore creating more demand for the stock and pushing the stock price higher. Now, when business conditions are weak, firms are more willing to reduce stock buybacks than to cut dividends. So, if the business conditions are poor, they'll cease buying back the shares of stock, but they don't want to really cut the dividends. That's generally done as a last resort. Okay, so let's look at earnings per share and dividends. So the orange line here represents the earnings. The dark blue line represents dividends, and these light blue areas represent one of the 10 recessions in the past 67 years. So our last recession was 2008. We're in 2017 over here. Um, no recessions so far. Now, when there's a recession, earnings dip. So you can see every time there's a recession, the earnings dip into the recession. So earnings start to actually dip just a little bit before the recession, and you can see in the Great Recession they dipped quite a bit and then returned pretty fast. And you can see here again, dividends are typically following earnings, and they also had a dip, but they don't dip as steeply as the earnings do in a recession. But the recession does change things, changes the decision making of management as they're trying to conserve cash because they may not know how long or how bad the recession will be. Let's look at P&G's dividend history. So, from 1950 to 2002, we see a really nice increase of their dividend. In fact, they've paid dividends every year for over 50 years. And this is a very reliable consumer staple company that, one of the big attractions of it is it has a very stable and growing dividend. Okay, so let's look at the aggregate dividends and purchases for U.S. stock. So here are the dividends on the orange this time, and then you repurchase a stock. So we can see here that generally dividends for most of the past 40 years, dividends have been a higher amount in billions paid out than stock repurchases. Then we see for the first time after 1999 that repurchases are overtaking dividends. During the recession, the repurchases dipped down, and then they expand again after the recession. Then the 2008 recession, they dipped down again, and now they've expanded even more so. So repurchases have become more popular than dividends over the last 10 years or so. And this is a trend that's happening worldwide. So it's not just limited to the U.S. economy, but repurchases have risen in all over the world over the last 20 years. So let's think about, when a company buys back their stock, which we call a stock buyback, they, in a way, are returning cash to shareholders because that's supposed to raise the price of the stock, and then shareholders can sell stock to recapture that increase. So now, when a company should technically really only buy back their stock when they feel it's undervalued. But typically, it seems like when the stocks are most undervalued during a recession, they stop buying back the stocks. And then when the stocks are fairly valued or overvalued, like right now, companies accelerate their stock buybacks. So they don't always it doesn't seem like they're buying them when the company feels they're undervalued. It seems like they're buying them when they want to convince everybody else the company is undervalued, or that they want other investors to think that they think the company is undervalued. So it's like a psychological sort of signal. Now, it's been speculated that companies can manipulate earnings to push down earnings before a buyback to make the stock seem undervalued and causing its price to bounce back higher after the buyback. So this is not something, managers should manipulate their earnings to do their stock buybacks. So it's really an ethical question. Should companies manipulate their earnings to gain advantages on stock buybacks if they're doing it mostly for the shareholders' benefit? So something to think about. Okay. Mechanics of payout policy, cash dividend payment procedure. So there is a procedure for paying out dividends. At a quarterly or semi-annual meeting, a firm's board of directors needs to decide the amount of dividend they want to pay. Sometimes companies have a precedence of paying dividends or growing dividends at a certain rate. So the board has to decide whether to maintain this persistent precedent or increase or decrease the dividend based on the firm's financial performance. Boards rarely cut dividends unless they believe that the firm is going to have a hard time to generate cash. It is in some sort of serious jeopardy. And when firms do cut dividends, it's speculated that drives stock prices down. And it's common sense, it does. So if a firm comes out and says, we're cutting our $3 dividend down to a $1 dividend, that gets shareholders worried, stock prices go down. So generally boards don't want to cut dividends, they want to increase them as best they can. So let's look at this chart now. Public industrial firms increasing, decreasing, or maintaining dividends. So let's look at number of firms maintaining dividends. You see that this peaked, but when we have a recession, fewer and fewer firms can maintain their dividends. Number of firms increasing dividends, and we'll see it's sort of up and down, but after, generally 2010, we see an upward tick on that. And firms decreasing their dividends, you see that this is the least, popular of the two trends, maintaining or increasing. Decreasing your dividends is something that you don't want to do unless your company's really fallen into hard times. Continuing with the mechanics of payout policy, there are a couple of dates that you should put on your calendar when there's a dividend. Now, the first date is the date of record. So this is the date that the directors say all persons whose names are recorded as shareholders receive the declared dividend at a specific time. So that's your date of record. Now, the firm's ex-dividend period begins 2 business days prior to the date of record. So if the date of record is Friday, March 10th, then 2 days before would be the ex-dividend date. So during which the stock is sold without the right to receive the dividend. And this is generally due to 2 days processing. So they make the data record and they go back 2 days to say that this is the ex-dividend date. So there's a sort of period between the ex-dividend date and the data record where if you buy the stock, you're not going to get the dividend. So if you own the stock, you're qualified for the data record, you will receive the dividend payment on the payment date. So let's look at this on a timeline. The timeline helps a little bit better. So the first thing is the declaration date. This is the date the company says, hey, we're going to pay a dividend. And then they say, we're going to pay a dividend on the payment date. So this is the day, October 1st is when we're going to actually pay the dividend, and August 21st is when they announce it. Now, they'll say, we're setting the data record on September 10th. Now, that happens to be a Tuesday. So we have to go back Monday and then Friday because weekends don't count. So 2 business days later, Friday is the ex-dividend date. So in between here, between September 6th and 10th, the stock begins to sell ex-dividend on Friday, and which is 2 business days before the data record, which is on September 10th. So if you buy it between here, you won't get the dividend. So you need to own the dividend on the ex-dividend date to receive it on the payment date. Okay, if you buy the stock at any point after the ex-dividend date, even if it's Monday, September 9th, or Tuesday, September 10th, or Tuesday, September 15th, not going to get the dividend. You're only going to get the dividend if you own the stock in the ex-dividend date. Okay, so let's look at this is basically that same example on the timeline, but we'll put some dollars to it. So if Best Buy announces a 17 cents per share dividend payable on October 1st, the data record of September 10th, then the stock would be trading the ex-dividend on Friday, September 6th, and at that time Best Buy had 340 million shares of common stock outstanding, so the dividend would be 57 million. So before the dividend was declared, the key accounts of the firm were as followed: cash 680,000, retained earnings 3.395 million. Now, when the dividend was announced, the directors had almost $58 million in retained earnings. Oops. Okay. Just seeing if that matches up. And 17 cents per share, or 341 million shares transferred to the dividend payable account. So the key accounts would be cash. Then the 58 million would be moved to the dividends payable account, and the retained earnings would be reduced. So here the retained earnings are 395, and now they're reduced by basically 58,000. Okay. Then when the dividend gets paid, it gets paid out of cash. So we would dividends payable would go to zero, cash would move down by 58 million, and therefore the balance sheet would balance. Okay. Now let's talk about the mechanics of payout policy and the share repurchase procedures. The most common is the open market share repurchase, where the company will just go and repurchase the stock in the stock market. So they'll just purchase some of the outstanding shares in the open market. The most common, easiest method to do. They can also do a tender offer, which they could basically say, we're going to repurchase stock. Say the stock's at $30 a share. We're going to repurchase stock at $31 a share and 1 million shares. So then everybody who wants to sell that amount could put in a proposal to buy it at the premium relative to the market share, and then the shareholders decide, whether or not they want to sell their stock at that price. And if they do, then they will get the stock. But just generally, the one benefit of this offer is it may tend to move the stock price up if the company is willing to pay for shares of the stock at a higher price in the market it's currently priced at. Now, a Dutch auction repurchase is a method which is least common, but basically sets a range, and then you bid on the shares you want to buy. So it may, let's see, let's see if we're going to have, but maybe it would show the mechanics of this. But if you had you could say a range between the company can say we want to repurchase in the Dutch auction between $20 and $30 per share. So then the people who put in the people they'll start buying the shares from the lower price to the higher price. So if people are willing to sell it back at $24 a share and other people are willing to sell it back at $26 a share, they'll buy the $24 share better. So the game is basically you want to put a bid in for the stock that is a price at which you think you'll get it, because if you go too high, nobody will buy it. And if you go too low, then you're selling your stock for too little. So the Dutch auction really is not the most popular way of doing it, but it has been used and still is used today. Okay, so let's see. On July 13th, Fidelity National Information Services announced a Dutch auction repurchase of 86 million common shares at the price ranging from 29 to 31.50. So here would be the range of the offering prices in the auction. So the price of 31.25 dollars. Shareholders are willing to tender a total of 86 million shares, exactly the amount Fidelity wants to repurchase. So that means that at this level they would purchase the stock at that price. But by and large they would want to purchase at the highest price first and work their way backwards. So if it's a very popular auction, they'll sell the stock mostly at the higher range of the prices. Okay. Now let's talk about the mechanics of payout policy, tax treatment of dividends and repurchases. So depending on the tax law, the taxes for dividends and share repurchases are always going to differ. So with the dividends, investors receive, what the dividends you receive were in the past generally taxed as your ordinary income rates. And then when firms repurchase stock, they didn't really trigger any tax consequence because they were rebuying the stock and maybe pushing the price up, but you wouldn't face any taxes unless you actually sold the stock. So now if they repurchase the stock as a shareholder, you don't have to participate in owing any taxes. So you don't have to participate in the repurchase program. You don't have to owe any taxes. You don't have to sell the stock once they repurchase and maybe the stock price goes up. So you have a lot more control over a stock repurchase than a stock dividend. Now things changed significantly in 2003 when they enacted a new tax law. So under this tax law, they reduced the capital gains tax on corporate dividends for taxpayers at a rate closer to the capital gains rate, which had a minimum of 5% and a maximum of 15% depending on your tax bracket. And this was to alleviate some of the double taxation that dividends face. Because remember that the company makes money, pays taxes on it, then it gives the dividends to shareholders and they pay tax on it again. So this is a double taxation. So they wanted to minimize this double taxation of dividends. So if you're going to pay lower taxes on the dividends, dividends can become more valuable for you because you take home more of them after taxes are paid. So the American Taxpayer Relief Act of 2012 extended the 15% rate on capital gains and dividends for taxpayers in all but the highest tax brackets. So let's also talk about capital gains and dividend tax treatments extended to 2012 and beyond. So prior to 2003, dividends were taxed at a very high rate. So it could be a cumulative tax of almost 58% on dividends, depending on if you're in the highest brackets for the company and the federal income tax on your dividends. So it didn't completely eliminate this double taxation, but it lowered it from that top bracket from 57 to 44 and from 35. So for taxpayers in the lower bracket, it would go down to a cumulative of 38%. So the American tax relief of 2012 extended this 15% rate for taxpayers in the 25, 28, 33, and 35% income tax brackets. However, if you made more than 400,000 as a couple or a single, you're going to pay the 20% capital gains rate and a 20% dividend rate. All right. Now this actually, when they lowered the tax rate on dividends, encouraged more companies to pay dividends, since taxes were less a concern and less of a concern for shareholders. So they were more willing to. And remember, a lot of the officers of the company and families that own the companies, they own a lot of stock. So if the tax consequences are reduced, then there's less of a fight not to issue dividends. Okay, let's talk about DRIPs, or dividend reinvestment plans. Dividend reinvestment plans are the only way that you can buy stock directly from companies, circumventing the stock market and the capital markets. So with a dividend reinvestment plan, you buy directly from the company. And then any dividends your shares earned, you get fractional shares from the company as well. So this is a great way of reducing commissions and increasing your ownership of the stock in a small. They can give you fractional shares. So this is one of the first plans ever to give you fractional shares at very little cost. So you can make sometimes you have to own the stock first, sometimes you have to work for the company, or sometimes you can buy the stock directly from the company without going through a broker, which is the brokerage charges all the commissions. So you acquire shares in a company, say you were in McDonald's DRIP program, then you buying stock directly from McDonald's, not from a broker or brokerage or stock market. You buy it from McDonald's. Any dividends McDonald's pays gets reinvested into new shares in your dividend reinvestment plan. So the advantage, of course, is you greatly reduce your fees and your commissions. The disadvantage is, if you would have to have, say, 30 dividend reinvestment plans in 30 different companies to have sort of a balanced portfolio. For every company you have a dividend reinvestment plan in, you have a separate account, and you have a separate tax filing, and you have a separate statement. So the record keeping and bookkeeping of the dividend reinvestment plans can become pretty intrusive. If you have a brokerage account, all the stocks can be put in one brokerage account. Everything can be consolidated into one tax report, one tax filing, one statement. Much easier to keep track of things. So dividend investment plans were really unpopular when commission for buying stocks were very high, $75, $125 a trade. Now that commissions are down to, say, $5 a trade, these dividend reinvestment plans aren't as attractive. And also there are plenty of stock brokerage accounts that will allow you to buy stock in fractional shares. Previously, only DRIP plans would allow you to do that. Okay, so let's look at stock price reactions to corporate payouts. So what happens to the stock price when a firm pays a dividend or repurchase stock? So in theory, when a stock trades on the ex-dividend date, the stock price should fall exactly by the amount of the dividend. So, and I've seen this happen quite often. So when Microsoft had a special dividend of $3 a share, say Microsoft was trading at $25 a share, after the ex-dividend date, the stock went from $25 to $22 a share, denoting the fact that the dividend is no longer attached to the stock price. So the stock price, because you're basically removing that value from the company, so the stock should fall exactly by that amount. Now, when a firm buys back shares at the going market price, the market price of the stock should remain the same. But generally, when a stock buys back shares at the going market price, the market price of the stock does go up because of the increased demand. So in practice, taxes and a variety of other market imperfections may cause the actual change in share prices in response to dividend payments or share repurchases that deviate from what's expected, in the theory. So let's talk about some of the theories, the relevance of payout policy. So there's a lot of theories surrounding dividends and payout policy and repurchase of stock, the effect on share prices and investor sentiment and things of that nature. And it does provides some interesting reading about payout policy, capital budgeting, capital structure, um, and the payout decisions. But firms should never sacrifice a good investment just to issue a dividend or buy back stock. So that would be a questionable policy. Why are you paying out a dividend when you could have made a better investment and got a better return for shareholders? Generally, companies should only pay a dividend when they have no better way of making a return for an investor. So, does paying out a dividend or the dividend policy have a significant effect on the value of the firm? And that's what a lot of the research looks at. So the relevance of payout theory, the residual theory of dividends. So the residual theory of dividends is one way of thinking about it, where it suggests that dividends paid by a firm should be reviewed as a residual, the amount left over after making all the acceptable investment opportunities. So this residual theory is that dividends are just what's left over. So after the capital budget is made, which we know from our previous chapters 11 and 12, so after all the projects that are valuable are taken, and if you have money to spare, there's either no projects worth the return they're offering, and you've invested all the money you can invest at this point, then the rest the residual amount you could return as a dividend. Now, using this residual theory of dividends, a firm would treat the dividend decision in 3 steps. 1, determine the optimal level of capital expenditures, which would be the level which all of the projects would have a positive net present value, which we know from chapters 10, 11, and 12. So basically saying, figure out how much you need to spend on your new projects. Using the optimal capital structure proportions, estimate the total amount of equity needed to support the capital projects in step 1. Now, because retained earnings is usually the cheapest of the equity, it's generally the cost is less than issuing new stock, so you're going to use retained earnings to meet most of your equity requirements determined in step 2. So if retained earnings is adequate to meet everything that's needed in step 1, then the excess should be distributed as a surplus, as a residual, as dividends. So the dividend irrelevance theory. So the dividend irrelevance theory is again from M&M. These two guys who did a lot of the work in dividends and capital research many years ago. So their theory, in the perfect world, a firm's value is determined solely on its earnings power and the risk of its assets, its investments, and the manner in which it splits its earnings streams between dividends and internal retained earnings or reinvested funds doesn't matter in the effect of its value. So they're saying in the perfect world, when you're not looking at taxes or transaction costs or other market imperfections, the value of the firm should be unaffected, not changed by any decisions of dividends. And of course, there are no perfect markets, but it was an interesting theory that they looked at to say that it shouldn't really affect the stock price. Now, the clientele effect is it argues that different payout policies attract different types of investors to the stock. So if you have a stock with a very high payout of dividends, then you should attract people who are tax exempt. So tax-exempt investors may invest more heavily in firms that pay higher dividends because they're not worried about the taxes because they don't pay any taxes. Investors who have to pay high taxes or high, earning individuals who would pay high tax and dividends will prefer to invest in firms that retain more of their earnings and don't pay dividends. So if a firm changes the payout policy, the value of the firm should not change because the clientele mix will switch around, and people who don't like the current policy will sell, and it'll attract people who do like the current policy. So there might be a ripple effect in the stock price, but overall, the value of the firm should be in the assets of the firm and not in its dividend policy. So let's talk about some arguments for the dividend relevance. So in the dividend relevancy theory, there is a direct relationship between the firm's dividend policy and its market value. And it's sort of the bird in the hand argument. So in this belief, it says that if you're going to get a dividend, that's more valuable to investors than future possible capital gains or dividends in the future. So dividends paid today are more valuable than dividends in the future, so it makes them more relevant. It should make the stock price go up. So dividends paid, promised to be paid now, should have an effect on dividends that may be paid in the future. So other studies have been done that show that large changes in dividends do not affect the share price. So, what we call informational content, this information provided by the dividends of a firm with respect to its future earnings. So it kind of makes sense. When a company is confident that they're going to be bringing in money in the future, then they'd be more confident to raise their dividend because they feel they can support it. Because remember, companies never want to decrease their dividend, so they wouldn't raise their dividend unless they felt confident that they could pay it. So that's an important informational content when companies raise their dividends or lower their dividends. So the agency cost theory says that a firm that commits to paying dividends is reassuring shareholders that managers will not waste their money because they're kind of committed to this and they feel confident that this is going to happen. Okay. So factors affecting dividend policy. So we have some factors that are going to affect, a company's decision to pay dividends. So their plan of action when they make a dividend decision, they have to think about legal constraints. Legally, are they constrained from paying the dividends? And that could be, there are certain laws that do affect the level and how much a company can pay a dividend. For example, they don't want companies to. The reason they have this is they don't want a company to go out, borrow a huge amount of money, pay it all to dividends to investors, and then go bankrupt. So you could see how that could be fraudulent. If a company did that, then the owners of the shares would be very wealthy. The company wouldn't really even have to make anything. You just have to go out and borrow a lot of money, pay it all out to dividends as investors, and then the company go bankrupt, and you're basically stealing from the bondholders and banks. So that's why there's legal constraints. There's contractual constraints. There might be contracts that they have with other companies or the government that will say you can't pay a dividend for this period of time or this percentage, or you can only pay a dividend up to this percentage. So there could be a contractual constraint meant to protect partners in the other partners in the company from the company putting itself into risky of a position. The firm's growth perspectives. So if the firm is going to have a lot of growth perspectives, they shouldn't pay too much in dividends. So that's definitely going to be a factor. Owners' consideration, how the owners of the corporation feel about the dividends and what they would like. And the market considerations, what the market expects and what the market would really value. Okay. So let's talk a little bit more specifically about legal constraints. So most states prohibit corporations from paying cash dividends on any portion of the firm's legal capital, which is typically measured by the par value of the common stock. So that's one particular law. Other states define legal capital. And remember, corporations are incorporated in different states. So different states have different state laws that they have to follow, plus the federal laws. So other states define legal capital not only to the par value of the common stock, but to any paid in capital in excess of par. So paid in capital in excess of par is money investors brought to the company outside of the money they raised with stock. So these capital impairment restrictions are generally established to provide sufficient equity base to protect creditor claims. So like I said before, you don't want to borrow money and pay it all out as dividends because that's really wasting the creditor's money that's lent, especially if the company goes bankrupt. So let's look at this legal constraint. So in states where the firm's legal capital is defined as par value of its common stock, and we'll look at this flour company paid out $340,000 in cash dividends without impairing its capital. In states where the firm's capital includes paid-in capital, the firm only paid $140,000 dividends. So we got our paid-in per par value, and we have our paid-in capital in excess of par, and our retained earnings. So this is where it's saying that you can only do $140,000 dividends, or just you can only pay out your retained earnings. Where in some states you could do your pay out retained earnings and paid in capital. So a firm has overdue liabilities or is legally insolvent or bankrupt, it's prohibited from paying cash dividends. In addition, the Internal Revenue of the IRS, Internal Revenue Service, prohibits firms from accumulating earnings to reduce owners' taxes. So um, excess of earnings accumulation tax is the tax that IRS levies on retained earnings above $250,000 for most businesses when it determines that the firm has accumulated an excess of earnings to allow investors to delay paying taxes. So basically, if the owner doesn't want to pay any taxes, they'll try to keep all the money retained in the business and just not receive any of it. And maybe be waiting for a time where their tax exposure is less. But the IRS doesn't like that. Contractual constraints, the firm's ability to pay cash dividends can be constrained by provisions in a loan agreement. So a loan agreement, like a mortgage on a big property or buying another business, could say no dividends until you've paid back this loan, or they achieve a certain level of earnings, or they might be limited to dividends to a certain dollar percentage of their earnings. And it's to help protect the creditors and make, these provisions in the loan agreement could make the interest rate on the loan much less because it makes the loans less risky. No growth prospects. If a firm is likely to depend heavily on growth and financing through retained earnings, it's likely to pay only a small percentage out or nothing out as a dividend because they're in a better position to take advantage of this growth than to pay out dividends. And it would be wasteful to pay out dividends while they're borrowing money to fund their growth. Okay. So the owner's considerations, if the owner of the company, you'd have to look at, because not only public companies pay dividends, private companies can pay dividends too. So you'd have to look at the tax status of the firm's owners, and you'd want to do the dividend policy that would be advantageous for the tax benefits of the owner. And you also want to look at the owner's investment opportunities. If they have a better investment opportunity externally, then they should pay a high dividend so he could take that money and invest it somewhere else. Now, if a firm pays out a high percentage of earnings, new equity capital may have to be raised in common stock, and that could dilute the shareholders of the owners, and that's another thing to worry about. Market considerations, the catering theory. It's a theory that says the firm caters to the preferences of investors, initiating or increasing dividend payments during which periods in which high dividend stocks are particularly appealing to investors. So sometimes they'll change the policy to cater to what the market's looking for, hopefully to get the stock price to go up. Okay. Now if we talk about types of dividend policies, constant payout and payout ratio dividend policy. The dividend payout ratio, this indicates a percentage of each dollar earned that a firm distributes to the owners in the form of cash. So we calculate it by looking at the cash dividend per share and by its earnings per share. Now the constant ratio dividend policy is a dividend policy based on the payment of a certain percentage of the earnings to owners in each dividend period, say 5%. And this is an example of a 40% payout of 40% earnings. Okay. So there could be a regular dividend policy, which is a dividend policy based on the payment of a fixed dollar divided in each period. So here they don't give a percentage, they give a fixed dollar amount. So a regular dividend policy is often built around a targeted dividend payout ratio, which is a dividend policy under which the firm attempts to pay out a certain percentage of earnings as a stated dollar dividend and adjusts that dividend towards a target payout as proven earnings increases occur. So it's a target we're shooting for, and we're going to pay out a dollar amount, but we're shooting for this target that's sort of like a moving target based on how earnings increase. All right. So here in a regular dividend policy, you can see the dividend per share, it stays pretty stable. Then they increase it at 50 cents, and that's just a regular continual policy until they make a stated change. But initially, it was paying a dividend of $1 per share until earnings exceeded $4 for 3 consecutive years, and then the point that the annual dividend was raised to $1.50 per share. But it's a stated regular dividend Probably I would say the way most companies would do it. Now, low regular and extra dividend policy. So low regular and extra dividend policy. It's a dividend policy based on paying a low regular dividend. So like say $1 a year with a supplemental extra dividend that gets paid if earnings are better than expected. So if we get a really good year, we could play this supplemental dividend. So you get you're getting two dividends. You get just the base dividend and then sort of a bonus dividend based on how well the company performs. And then occasionally, that's on a yearly basis, but occasionally an extra dividend can pop up, not annually, but once in a while, maybe they win a big lawsuit or something, or they sell off a part of a business, and they can pay a special dividend that's higher than the normal given period for a special reason. Now, a stock dividend is when they decide to pay stock instead of money. So they can say, we're going to give a stock dividend rather than a cash dividend. This is confusing because when we say stock dividend, we always think of money, but in this particular case, we have stock dividends that pay cash and stock dividends that just give owners more stock. But it's like a very small stock split. So the owners don't actually really get anything because when they give the extra shares of stock, they lower the price of the stock to adjust for the fact that they gave extra shares of stock. So let's see. I'll show you an example of this in a second. Is this the example? Okay, so we'll go over that in a second. But a couple of things to point out here. You're receiving extra shares to the shares you already own. So if you had 100 shares and it was a 10% stock dividend, you now have 110 shares. Now, because the number of shares increases, the stock price declines roughly about the same amount of value. So if you had, say it was $1 a share and you had 100 shares, so you basically, $1 share, you have 100 shares, that's $100 in stock. Now you have $110, you have $110, I'm sorry, you have 110 shares of stock. How much money do you have in your account? You still have $100 in your account because now the stock's worth about 91 cents. So the stock went down 91 cents, so 91 cents times 110 shares is $100. So you still always have the $100, you just have more shares of stock at a lower stock price. Sort of a lot like a stock split, but this is like a small stock split. So let's look at the equity in the balance sheet. They're going to a preferred stock of 300,000, common stock 100 shares at a $4 par, which gives them 400,000 in common stock. Paid in excess $600,000 paid in excess of capital, 700,000 retained earnings. So total stockholder equity is $2 million. If you add this up, we get 7, 13, and $2 million. Okay, so now they're going to declare a 10% stock dividend. When the stock price is trading at $15 per share, the result is as follows. The preferred stock stays the same. The common stock now is 110,000 shares at $4 par, or $440,000 of common stock. Paid in excess of capital is 710, and retained earnings is 550. So what changed? We're still at 2 million. So let's just go back. If you see what changed is the common stock went up by 40,000. However, the paid in excess of capital in excess, that also got increased to 110,000. And then we see retained earnings decreases from 700,000 to 550,000. The same amount that if you look at the 110 that went up here and the 40 that went up here. So that's basically how the balance sheet would be treated in this 10% stock dividend. So let's continuing with this. Say you own 10,000 shares of this company, and the company's most recent earnings were 220,000. Earnings are not expected to change in the near future. So the stock dividend at 10%, while the stock is selling at $15 per share, let's do the effect. Because you own 10,000 shares, her earnings were 22,000 or $2.20 per share. After receiving a 10% stock dividend, you're now going to have 11,000 shares of stock because 10% is 1,000 shares. So now 11,000 shares of stock, which again is 10% ownership. So you have 1,100 shares of stock out of the 110,000 outstanding shares. So the market price would drop to $13.64, which is basically this formula. The 15 times 1 divided by 110 would give us 1364. So the holdings are 150,000 or 11,000 times 1364, which is the same as before when the stock was $15 and you had 10,000 shares, also 150,000. But the earnings would drop to $2 per share because there's more shares outstanding now. So kind of confusing, I know. Now, a company can also do a stock split. Now, this is generally you could have a 2-for-1 or 4-for-1, but you're getting the stock is splitting. Okay, so if you had 100 shares, let's see. If you had 100 shares of stock and you split 2-for-1, now you have 200 shares of stock. So if you had 100 shares of stock at $10 a share and it splits 2-for-1, you have 200 shares of stock at $5 a share. So you really don't get any money here. It's just splitting the stock and cutting the price in half. So you have double the shares but at half the price. Now, but companies can also do a reverse stock split where they take. So AT&T did this a number of years ago after it sold some of its divisions. Stock price was going down, and they had to get the stock price up because it was below $5, which was bad. It was going to be kicked off the exchange, and people really don't give stocks that are under $5 or $10 any respect. So they did a 20-for-1 reverse stock split to get that stock price higher. So they could do it in the other direction as well. Okay, so here's before the split. Here's another example of a stock split. So before the split, we have 200,000 shares at $2 par for 400,000. After the stock split, we'll have 2-for-1, doubling the shares. We'll have 400,000 shares at a par value of 1 or 400,000. So you see the par value also decreases. Paid in excess of capital doesn't change, and retained earnings doesn't change. Okay, so that is the payout policy chapter, and I believe we met all our learning goals for this chapter. We talked about cash payouts, procedures, their tax treatments, the role of dividends in reinvestment plans. We looked at the residual theory of dividends and key arguments regarding dividend irrelevance and relevance. We discussed the key factors involved in establishing a dividend policy, and we reviewed and evaluated 3 basic types of dividend policies. We evaluated stock dividends from an accounting shareholder and a company's point of view. And lastly, we explained stock splits and the firm's, here's something I didn't fully explain, the firm's motivation for undertaking them. So why do companies want to do a stock split? This is why we review the learning goals in this chapter. Because if you have, say, you're right now Amazon and Google, these are stocks who have hit $1,000 per share. They're not currently at $1,000 per share, but $1,000 per share, that's very few people can buy that stock at $1,000 a share. So there's not a lot. It lowers demand for the stock. Those stocks tend to be so strong, though, that even $1,000 a share doesn't prevent many people from not buying them. But if you're a regular company, if you're not an Amazon or Google and you're a regular company, you need to have your share price in what they call a sweet spot. Between $35 to $65 a share is where most consumers feel comfortable buying that stock. So if a stock price gets too high, gets to $100 per share, they would like to do a 2-for-1 stock split to get that stock back closer to $50 per share, because that generally induces more demand for the stock and push stock prices higher. And there's also a signaling effect. When a firm is signaling a stock split, investors feel like the company's management must feel that the stock has a strong enough footing to sustain a stock split and continue to go up. And people, by and large, love stocks that continually split. I think Microsoft, Home Depot, Cisco, Qualcomm, companies like this split their stock over 10 times. So if you were owning that stock and you started out with 100 shares, so the first stock split you have 200, then 400, then 800, then 1600, then 3200. And that's after 5 stock splits, you go from 100 to 3200 shares, and the stock price keeps gravitating back to the price where you originally purchased the stock at. You can see how attractive that is. So splitting the stock, doing a stock split is a way of keeping the price of your stock in a range where investors feel the stock is not too expensive, but also, which increases them to buy it more, which increases demand, which helps push the stock price higher. But typically, only strong or growing companies can split their stock, and that's another signal. So if you're splitting your stock, that must mean you're a strong or confident or growing company. So that's why many executives will consider splitting the stock to maintain the attractiveness and the demand for their company. Okay, so with all learning goals met, I'm ending this lecture on Chapter 14 payout policy, and I'll see you again in the next lecture. Thank you.